Hello, I am Dr. John Johnson, and today's date is December 6, 2021. And I am currently the treasurer for the Medical Association of Atlanta. I'm also a practicing board certified internal medicine physician within the state of Georgia. And I've owned an internal medicine practice in Douglasville, Georgia for the past 21 years called West Atlanta Internal Medicine. Today, we have a featured guest, Karma McCallie, who is the Advanced Medical Services Senior Director within the Life Insurance Division of Truist. Today, she'll be introduced by another outstanding guest, Matt Bracewell, who is the Senior Vice President of Wealth Advisor with Truist. And he's been in the medical services group for the past 11 years. Matt, why don't you kick us off by introducing Karma, but before you do that, we want to help our guests understand what we'll be talking about today. Today, we're going to talk about all of the new things coming out of Washington, D.C. as it relates to end-of-year financial planning. There's been a lot of concern in the finance industry over the proposals that Washington had, and lots of business owners were really concerned about what was going to come through the legislation. So today, we're going to get Karma's perspective on what those updates are and what we need to plan for. But before we do that, Matt, why don't you kick us off by introducing our guests?
Thank you, Dr. Johnson. The Medical Specialty Group at Truist was specifically built to help physicians and their practices navigate the complexities of our ever-changing environment, blending expertise and innovation to bring your vision to life. From banking to brokerage to trust and planning services, Truist Wealth streamlines wealth management through customized, comprehensive planning, sophisticated financial solutions, and attentive service. As a result of the merger between SunTrust and BB&T, we now have access to an expanded universe of solutions to help our clients. One of those avenues is Crump Insurance Services. Crump is one of the largest distributors of life, disability, and long-term care in the country. Of the many resources we have, few shine as bright as Karma McCallie. Karma is our Director of Advanced Markets. She's an attorney with over 25 years of estate and business planning, including a time managing her own law firm. Karma and her team have close resources in Washington that give them the inside baseball and updates on what's happening with current tax proposals in Washington. Given all the recent back and forth, our time together this evening is timely. Ladies and gentlemen, it's my pleasure to turn it over to Karma McCallie.
Well, thank you so much, Matt and Dr. Johnson. Thank you both so much for having me on the call this evening. You know, I've got to tell you, you could not have picked a more fluid, dynamic topic for us to be talking about at the very beginning of December. So we've been watching a lot of these proposals bouncing around in Washington for almost a year now, right? I mean, we started seeing them in February, early of this year. So been watching them very closely, and it's almost the end of the year, and we still don't have a lot of the answers that we had expected that we would. But there is a lot of information that we can share this evening. So we have made some progress. So I think what we want to talk about this evening is, in light of some of these ideas in Washington that I want to share with you, and some of these proposals, what are the next best steps? What are some of the best practices and some of the things that we should maybe be wrapping our heads around for the end of the year? So let's just jump right in and talk about some of the stuff that we hear going on. So I've been spending the last few months a substantial amount of my time, on calls, WebExes, with groups inside of Washington, both industry groups, financial industry and insurance industry groups, as well as just, lobbyists and various contacts that we have inside of Washington, just to make sure that we're staying up to date on, all of the information that we can get, and to keep it as timely as possible. So the last couple of weeks, it's been a little bit quiet, right? And that's understandable. We just got through the Thanksgiving holiday. But right before that, on the 19th, the House did pass the Build Back Better Act. Now, that was right on the heels of the infrastructure bill. And so I'm sure that a lot of you that are watching probably saw that when it happened, the House, passage of the act. It was kind of interesting the way that it actually played out, though. That act is huge, and it deals with all kinds of what we're calling social infrastructure agenda items. But those almost in a lot of circles were overshadowed by the proposed funding for the act. So that's what we're going to talk about tonight. We're not really going to be talking about the provisions, the social infrastructure provisions of the act. But those are, of course, readily available to you if you want to do a Google search. But we will be talking about some of the funding because it's a massively expensive act that has been proposed by the House. So it was interesting in terms of seeing what it made the final cut in terms of funding, what is included in the act. So let's go over a few of those. So there's going to be inside of the House proposal that was passed, there would be a surcharge of 5% on all AGI, anyone who has AGI over $10 million, plus an additional 3% surcharge over $25 million of AGI. Now, for some high net worth clients, that's a new issue to be considered. That's not something that we had seen thrown about earlier this year, so it was a little bit of a surprise to some folks, I think. There are also going to be limits on contributions to IRAs over $10 million. So the idea there was the House felt like that qualified money IRAs, there probably should be some kind of almost like a cap on how large those accounts can grow, or at least when contributions should be shut down. So accounts over 10 million, there would be a limit on contributions. And there would be an acceleration of RMDs for accounts over 10 million. So all of the qualified accounts would be aggregated together. Anything over the 10 million, there would be an acceleration of RMDs for those accounts. Now, there is an interesting corporate tax that was included as well. There would be a 15% minimum corporate tax. So we're establishing a floor for corporate tax here for corporations who have profits over $1 billion. So the thought there was that there are some very large corporations, and I'm sure we can all think of examples that we've seen in the media, very large corporations out there who annually are paying very little in income tax. And so this is going to establish a minimum amount that those corporations would be paying in income tax every year. Remember the discussion around the SALT deductions back in 2017 when we had the big tax act, that's our state and local tax deductions. Those were capped at $10,000, and for a lot of folks, especially in in states that had very high property taxes, that was a serious reduction in a big deduction that they were used to taking. The proposal would raise that $10,000 limit to $80,000 and extend that through 2030. So there are various provisions of the 2017 law that are set to expire in 2025. But this one would not expire in 2025. It would be extended through 2030. So, that's up to this point, we've been talking about funding taxes and that kind of thing for the funding. But this, I think, would be a huge benefit for a lot of taxpayers. And finally, one that is getting surprisingly, and to me, I'm kind of surprised by the volume of press that this one is getting. An $80 billion contribution to the IRS for enforcement efforts. And what that's going to look like, it seems like from reading through all of the different proposals, is an additional contribution for salaries to hire more IRS agents, as well as to increase the technology. A lot of the IRS technology is very, very dated, and it makes it very difficult for them to do audits, especially on very complicated either estates or taxpayers and companies as well. They just don't have the technology and the agents to pull it off. So this contribution to the IRS would significantly enhance their ability to bring in top talent as well as to increase the technology. So all of that together is the big items for the proposed funding. There's some other ones in there as well, but the big items for the proposed funding. Running into a little bit of a scoring issue in terms of whether or not these proposals would actually generate all of the income needed. And so that's what there's been a little bit of drag. the last couple of weeks in terms of trying to figure out how to score all of these. But for the most part, those are the big proposals that were included for the Build Back Better Act.
Thank you very much, Karma. That's a good bit of information for us to unpack and understand, realizing that there is not a sense of urgency any longer since some of these were either postponed or delayed. But help us understand for those things, the number of previously considered tax proposals. So some of the items did not make the cut. What were some of the major proposals that the financial planning industry was watching for that were dropped, that perhaps we now have more time to plan for?
Yeah, Dr. Johnson said that is a fantastic point. You know, I think that, at least for me personally, following all of this through the House, it was much more interesting to me to see what didn't make it as opposed to what did. So a lot of the things that we, at least in the financial services industry, as well as our clients, were most concerned over did not make the cut. So that's great news for all of us, right? So some of the big ones were the individual and corporate rate and income tax rate increases did not get included in the final version. So you remember that the proposal was to raise the maximum individual rate from 37 back up to 39.6, raise the corporate from 21 to somewhere around 25, 28. There were a couple of different numbers that were floated in different versions of the proposals. And to raise the capital gains tax rate as well. So those were originally included in the first proposals out of the House. Those were completely dropped. Now, that doesn't mean it's going to go away, though. The individual rates are still scheduled to increase back up to 39.6 at the end of 2025 under current law. So that's going to happen automatically. But at least we do have a few more years there to where we can plan for it. Awesome. Another big one was the estate and gift tax exemption reductions were not included in the final proposal. So right now we enjoy a very, very high estate and gift tax exemption, meaning right now, if I were to pass away, I can leave up to 11.7 million this year to my heirs without paying estate tax on it. Same thing if I'm alive, I can make a gift of up to 11.7. Now that's a huge number. It's the highest exemption that we've ever seen. And one of the proposals that we thought had a very good chance of going through was to basically reduce that down in half. It was to reduce it back to $5 million as adjusted for inflation. So we were estimating it was going to come in just a little bit north of $6 million. That one was dropped sort of at the last minute. So it was kind of a shock to some of the folks that were watching. But again, that one's another one of those proposals that is scheduled to automatically decrease in 2025. So, you know, looks like we'll get to probably enjoy a few more years of those high exemption numbers, and then they're going to come down. They'll sunset automatically under current law. Now, a couple of the big planning proposals planning techniques that we work with frequently, at least in my part of the industry when we're talking about estate planning and business planning, were sort of in the crosshairs as well, and that was very disconcerting to those of us that you know, work in that high net worth space where our clients are trying to look for efficient ways to transfer wealth and create a legacy. One of those was around something that we call grantor trusts, and I won't get too terribly granular here, except to say that grantor trusts are a phenomenally efficient way, type of trust that we use to be able to transfer large amounts of wealth for very little to no gift tax cost. The way that grantor trusts work, they're still included in the grantor's estate for income tax purposes, but they're outside of the estate for estate tax purposes. And there's a lot of leverage there that we can use in terms of you know, selling assets to the trust, those kind of things. The proposals would have eliminated that planning technique. And it really was kind of throwing the whole estate planning arena into sort of chaos for a short period of time there. So fortunately, those proposals were not included. I spoke recently with an industry insider, a very trusted industry insider, who said that the reason that those ended up not being included was basically because the insurance industry, lobby groups did their job. And made sure that Congress understood how phenomenally complicated those proposals were going to be. There was going to be a lot of questions that we had identified So basically they did their job, and it's a good thing. So it looks like that the grantor trust proposals are not included. Also, another thing that we do sometimes is what we call taking valuation discount. Valuation discounts on assets that are going to be transferred. I'm betting that some of you watching have probably used valuation discounts in the past. They're very popular, especially for like transferring, for example, closely held family businesses, where there's a lack of marketability, maybe a lack of control, and we can end up theoretically transferring, let's say, $1 million worth of assets. If we can take a 30% discount on that, for gift tax purposes, it's only $700,000. So we've gotten that $300,000 out for absolutely no gift tax cost. Again, very efficient way to transfer wealth. Those valuation discounts were included in the original proposal. And they came out at the 11th hour. So the good news is that for planning, as Dr. Johnson, as you mentioned at the beginning in the introduction, the good news is that for planning, a lot of the areas that we were most concerned about ended up not making the final cut.
Yeah, thank you, Karma, for that perspective. So let's pivot back to what actually did pass. As you know, some things did pass the House. So what's next? And from your perspective, do you have any insight on how likely what's passed the House is to become passed into law? Help us understand that.
Yeah, so that's the big question right now, right? What happens next? So the way that it works now that that everything has gone through the House and the House has passed their version, which, for those of you watching, you may be aware of the fact that tax proposals start in the House. So that's the reason that it was important while we were watching for that House vote. Tax proposals have to start in the House. Now the Senate Finance Committee is tasked with coming up with reviewing what passed and then coming up with their version. So the Senate will put out a version that could be identical or could vary substantially, and the Senate will vote on their version. Assuming that the two, that we do get both versions passed, then we'll go into a reconciliation process where they're going to try to reconcile those two versions of the act and come up with something that all of Congress can agree on and that can actually be passed. So to answer your question in terms of how likely is it that what was passed through the House will actually become law, what we're thinking and hearing at this point is it's probably unlikely that as drafted that it's going to actually make it through the Senate and become law, because the Senate has already sort of picked out a few areas that they have a problem with.
Okay.
So we are expecting to see some changes in the Senate version. The good news is what we're hearing, with the exception of those valuation discounts, we don't think that any of the changes are going to impact the areas that we talked about that were not included, the exemptions, the individual income tax, corporate income tax. We don't think that those are going to be added back in. Now, anything can happen at the 11th hour, and there's always surprises out of Washington. But having said that, it doesn't look like that those are likely to come back. The one exception to that is the valuation discounts. Congress has, we've heard at least from some of our contacts, that the House has directed the Treasury to actually deal with valuation discounts through regulations, Treasury regulations, as opposed to actual legislation. Now, the benefit to doing that is it's much more expedient. It can be done a lot faster, and it's a lot simpler process to pass regulations than it is to pass actual legislation. So we do think we're going to see that one. I was on a call last week where I was told that the group that I was speaking with was expecting it as early as December 20th. I think that may be a little ambitious, but it could happen. That at least the regulations would come out for comment. They'll have to be commented on for a while before they'll become we'll see a final version. But we think that one probably, that there is a likelihood that we will see those valuation discounts be eliminated at some point in the future. So the other thing to keep in mind is the fact that, we are in December. We are in the very last part of the year, and Congress is facing a serious time crunch. They don't have a whole lot of time to move the ball down the field. They also have some major other issues that they're having to, year-end issues that they're having to address. So while we're watching all of this very closely, and of course, any movement, we're going to be pushing information out as quickly as we can. The further we get into the month, the more difficult it's obviously going to be for everyone to come together and come to some form of agreement.
Thank you, Karma. I've got one final question for you. So just to recap, from what I'm hearing, we still don't really understand what, if anything, will pass. So help our viewers understand, how are we supposed to move forward with our financial planning in this environment of uncertainty? We don't really know what the law will become. So help us understand from your perspective how best to plan, given all the uncertainty in Washington.
Yeah, and so that's hard. I understand that for a lot of clients, it's a really hard thing to sort of look at all of this uncertainty and I don't knows and well maybes and try to figure out what's the best path forward. I always like to tell folks, though, when I'm talking to them, you plan for the law that you have and stay flexible enough to pivot for the law that might come. So we know what the law is today, right? We know what we have, and we also know that we're facing a year-end deadline. So there's a lot of things that we can do by year-end to take advantage of current law. So let's talk about a few of those for just a few minutes. So I used to, let me say that before I went into advanced markets and corporate work, I was in private practice in Atlanta for several years. And when I was in private practice, we would always send out letters in the third quarter to our clients saying, the end of the year is going to be here before you know it, and it's a great time for us to sit down and review your plans. So that's the first thing. That's one of my old standbys that I always resort to. It's a great time to look at your plans and your beneficiaries and how everything is set up and see if everything is still working for you. Now, there are some opportunities that you can take advantage of. One of those is going ahead and making gifts by year end. If you're wanting to make gifts to benefit family members, children, nieces and nephews, siblings, whomever, the way that gifting works, or at least the way that gift tax works, is there's something called an annual exclusion that we get every year. Now, this year, that annual exclusion is $15,000. And what that means is I can make $15,000 gifts to as many different people out there as I want to, never even have to file a gift tax return. Those are sort of freebies. That's why they're called those annual exclusions. And you get those every year. They re-up every year. Now, interestingly enough, those are adjusted for inflation. And interestingly enough, in 2022, that $15,000 number is going to go up to $16,000. But it's a use it or lose it proposition. So if you don't make those $15,000 gifts by the end of the year, you can't couple those with your $16,000 for next year. You just lose it. So why not double up on the gifting now if you're in a position where you're wanting to move larger amounts of assets, over to your kids or even to a trust for your family members. The lifetime exemption is our other big gift tax exemption that we talk about a lot of times, and that's that 11.7 number that I mentioned earlier. Now, that one also is indexed for inflation, and it's going to go up to $12,060,000 next year. So, one of the things that we've been encouraging clients to do all along, since we weren't really sure what was going to happen with the estate and gift tax exemption, was to go ahead and make those large gifts now. If that's something you're interested in doing, take advantage of that large exemption while you have it, especially for very high net worth clients who have assets that, especially legacy assets that they want to make sure they preserve for their family. Go ahead and make that large gift now, knowing that after the first of the year, you can turn around and gift that differential. So like I said, it's going up from 11.7 to 12,060,000. So every year as it increases, you can continue to gift that differential. If you remember last year, required minimum distributions were suspended last year. So I'm kind of switching gears here. I'm talking about qualified money IRAs. Required minimum distributions were suspended for last year. That was not extended into this year. So another thing to think about are those RMDs that need to come out of those plans by the end of the year and figure out what you want to do with them. Now, if you don't need them, sometimes we can leverage them in planning into other assets if that's what you want to do. We can use it for some of this gifting that we were talking about. But if you don't need them and you're charitably inclined, there is something out there called the qualified charitable rollover. meaning that you can direct up to $100,000 of your RMD to go directly from your qualified plan to a charity, and it's not included in your taxable income. Now, it's not a deduction. It's just simply not included in your taxable income. So fantastic way to benefit charity if you and avoid bumping your income tax brackets up. If you truly don't need that distribution. But another thing that was extended, another provision that was extended into this year as part of the CARES Act last year, you may have heard that there was a provision that said that for clients that want, or for individuals that want to make cash gifts to charity, 100% of that is deductible for income tax purposes. Now, why does that matter? Well, usually when you make a cash gift to a charity, there are AGI limits as to how much you can deduct in any given year, and you can carry forward any that you can't deduct, but you may not be able to use the entire amount in 1 year. Usually cash gifts for public charities at 60%. Under the CARES Act, you can deduct 100% of cash gifts as long as they're made to a qualified charity. And again, they have to be cash. Now, it doesn't include donor advised funds or family foundations. So just kind of keep that in mind. But that's another planning opportunity as well. Those valuation discounts that we talked about, like I said, we do think we're going to see regulations, but we have not heard any mention of those being retroactive. So for those of you that might be talking to your attorneys and your accountants about doing some planning that would involve valuation discounts, I would say now is the time to do it. This is the one thing that I'll mention this evening that I think that there really is an imperative in terms of doing it as quickly as possible, because we could see those limitations around valuation discounts coming up soon. So, I think that now is the time to take advantage of that window of opportunity. And finally, the last one are those grantor trusts that I talked about. So grantor trusts there's a lot of, we could fill an entire different call and discussion around the planning opportunities around grantor trusts. I would suspect that probably some of you watching already have grantor trusts that you've put in place because they're incredibly popular. There are ways that we can draft grantor trusts to sort of plan for, now that we know that Congress is serious, or at least the Democrats are serious about maybe doing away with grantor trust status. There are ways that we can draft these trusts so that if that happens in the future, and if we get enough warning that it's going to, we can sort of fix it or turn off that grantor trust status so that there wouldn't be any negative repercussions, to you or your trust or the beneficiaries of the trust. So lots of flexibility that we can build into grantor trust now that we know, what the future of them may be. But I don't think that the fact that Congress is currently looking at them is a reason not to do them. There's just too much planning potential there. So for clients who are willing to go ahead and set up a grantor trust, maybe including that switch that we can flip off so that we can flip it over to a non-grantor trust, I think that you still have a window of opportunity for putting those trusts in place and taking advantage of some of that, serious planning that we can do around the grantor trusts.
Outstanding news, Karma. Well, on behalf of our members, our Executive Board of Medical Association of Atlanta, we really want to thank you, Karma McCallie, for all this exciting insight that you've given us tonight. Again, we're going to stay tuned for the changes and what comes out of Washington. On behalf of MAA, we'd like to thank you once again. And you've been listening to Karma McCallie, Senior Director within the Advanced Market Services Life Insurance Division of Truist. Thank you once again, Karma. For any follow-up questions, please direct those to our Director of Communications, Shannon Andrada. Thank you and have a good evening.
Thank you.